Chapter 3, Balance Sheet and Financial Disclosures. In this chapter, I will introduce the balance sheet in detail and what's the components, elements, and accounts reported in the balance sheet, and how we use balance sheet information to analyze a company's financial performance. As I mentioned in the prior chapters, the balance sheet reports a company's financial position at a point in time. The balance sheet is just like when we take a photo. The picture just shows the status at that moment. Well, the balance sheet only represents the financial position at a point of time. The balance sheet includes three elements: assets, liabilities, and equities. Each element includes many different accounts with different characteristics. And the balance sheet is also grouped according to these characteristics. For Nike, the balance sheet first is the name of the company and the name of the financial report and the date and the unit. So the date shows us that's the financial position on this date. One day before or one day after, the numbers in the balance sheet may change. The numbers in the balance sheet are reported in millions. On this page, we were provided the assets of the balance sheet. The assets are reported in two main categories. One is current assets. The other is non-current assets. Each we have the total. The sum of both is total assets. The typical current assets includes cash and cash equivalent, short-term investments, receivables, inventory, prepaid expense, and other current assets. Current assets also reported in the order of reducing liquidity. The prepaid expense generally is less liquid than inventory. Long-term assets, including property, plant, equipment, net book value, operating lease, right-of-use assets. So these two assets are long-term or long-life operating assets. The first one is owned by the company, while the next one, operating lease, is a leased assets. The next two are intangible assets. Similar to the property, plant, equipment, which is subject to the depreciation, these intangible assets are subject to amortization, which we will introduce later. Goodwill is an intangible asset, which is from the prior merge and acquisitions. The next one is deferred income tax and other assets, which will be introduced later in this course. This page reports the total economic resources owned or controlled by Nike on May 31st, 2020. The next slides report the liabilities and the stockholders' equity, the other two elements in the balance sheet. Similar to the assets, liabilities are reported as current liabilities and long-term liabilities. So the liabilities are reported in the order of their maturity. How soon this liability will be paid off or settled. The current liability includes these 6 typical current liabilities. Current portion of long-term debt. This account represents long-term liability in the prior year they become current, so we reclassify them into current portion of long-term debt. Notes payable, accounts payable, current portion of operating lease liabilities, accrued liabilities, income tax payables. Long-term debt, operating lease liability, deferred income tax, and other liabilities. So these debt or liabilities will be settled or paid off over 1 year. For assets and liabilities, whether they are current or long-term, depends on the 1 year cutoff. Usually 1 year or one operating cycle, which is longer, but most companies, their operating cycle is less than 1 year. So generally we use 1 year as a cutoff. Stockholders' equity includes contributed capital. Common stock represents the bar value of the stock. Additional paid-in capital is the difference between total contributed capital and bar value. Retained earnings are earned capital. This account is negative. It is reported as deficit. Positive, we report it as retained earnings. We can see Nike's retained earnings was negative $191 million. But here, it doesn't mean Nike doesn't make profits or does not accumulate profits, because Nike buy back stocks every year. The stock repurchase reduce the retained earnings. Accumulate other comprehensive income. So that's another account will be introduced later. Total liability was $23,287 million. Equity $8,055 million. Balance sheet, so total assets $31,342 is equals to the sum of these two. This is a real-world example from a real-world company. The usefulness of balance sheet. Balance sheet reports a company's economic resources, capital structure, liabilities, and stockholders' equity. And a lot of financial ratios that are used for analyzing a company's financial statement are derived from balance sheet. So it is a very useful financial statement for financial statement analysis. The assets are classified according to the common characteristics. As I mentioned, the most important common characteristic is the liquidity. So that's why assets are classified as current and non-current assets. Liquidity represents the ability of a company to convert its assets to cash. If the assets can be converted into cash earlier, sooner, it has greater liquidity. Cash is the most liquid asset. Cash itself is liquidity. The next one is we can analyze a company's long-term solvency. So this is related to the company's capital structure. The long-term solvency represents the company's ability to pay all its liability, not just current liabilities. This is related to the business capital structure. If the company has greater portion of the financing from debt, it also indicates the company has lower solvency. Financial flexibility represents the ability of a company to alter cash flows in order to take advantage of unexpected investment opportunities and needs. This is a more comprehensive financial indicator, which will be introduced later. Balance sheet is useful, but it also has limitations, especially its valuation. The book value of its equity is the difference between assets and liability, according to the accounting equation. But the book value is not useful information because book value do not directly measure the company's market value. There's two reasons. First, we use a lot of historical cost as a valuation for assets and liabilities. The historical costs lose relevance when time lapse. Next is some economic resources we may not report it in the balance sheet. Okay, for example, human resource, which is one of the most important economic resources for any business entities, especially for the tech firms. But current accounting standards, we cannot measure human resources reliably, so we don't report it. But it doesn't mean this is not a relevant information. Another one is the brand name. We do not report brand name as a valuable asset, but we know the brand name does generate value for the company. Because of these limitations, when we use the balance sheet, we should keep in mind these limitations. That's what I just introduced. Right? Assets classified into current assets and non-current assets. Liabilities, current and non-current liabilities. While equity, earned, and contribute capital. Which one is a sub-classification of assets in the balance sheet? The answer is current assets. Revenue is not reported in the balance sheet. It is an element in the income statement. The other two are specific assets, not sub-classifications of assets. In the following slides, I'm going to introduce all the elements and accounts used in this book.